Today's episode is brought to you by Lightyear, the investment platform I use for my stocks and shares ISA. Welcome to Many Happy Returns, where we aim to make you a better investor. Your portfolio was probably designed for falling interest rates and cheap oil. That is no longer the world we live in. Equity indices have minimal energy exposure, bonds amplify losses during a rising rate environment, and even gold is down 20% from its peak.
I want to know what you can actually do when the big asset classes are struggling. And in today's dumb question of the week, what is the Bloomberg Aggregate Bond Index? All right, let's get into it. So for most retail investors, their core portfolio will be some combination of stocks and bonds. The traditional way to think about it might have been a 60-40 portfolio, 60% stocks, 40% bonds. And the reason that has often been recommended to people is that those two asset classes generally have moved in opposite directions and complemented each other over recent decades. But there are times when that doesn't work, and we're in one of those times right now. Stocks and bonds both falling as markets price in the risk of higher inflation and higher interest rates. Now, Romin, your core portfolio is something of a 60-40, but with a bit of a twist.
Yeah, that's right. I've got a 60% equity allocation. That's completely standard. It's a global index fund. But the 40, I made a deliberate decision not to get longer duration bonds for precisely this kind of risk, which is if you do have the yield curve shifting up, then duration risk pushes down the price of your bonds. So that's not a risk I wanted to take. I just wanted to take risk off the table. I didn't want to switch from equity risk into duration risk. And I'm pretty glad I did that now because, as it turned out, there was this big inflation spike. The entire yield curve did shift up very sharply, and it hasn't really negatively impacted my money market funds, which are just very short duration, government bonds largely, with a smattering of other stuff.
Most people probably aren't in that position if they've got an off-the-shelf 60-40 or similar portfolio, where the bond component will usually be an intermediate duration, something like 7 to 10 years, I guess. And what's interesting is we don't have to go far back in time for a situation where the 60-40 let people down, do we?
No, any kind of inflation spike would hurt people. And obviously during the 22-23 sell-off in bonds, as we went from zero interest rates to something like 4 or 5% interest rates for much of the yield curve, that was a horrendous sell-off. And of course, a lot of it coincided with the tech wreck, when equity markets in the US sold off very sharply. So that was also a period when the two fell together.
I think a classic 60-40 fell by something like 17% in nominal terms in 2022. Lots of people were saying it was the worst calendar year for that style portfolio since the 1930s. If you adjust for inflation, it was down almost 25%, I think.
Yeah, if we look in sterling terms and we look at something like Vanguard's Life Strategy 60 fund, that was down about 15% over the course of 2021 to its nadir in 2022. That was in roughly November. So not as dramatic, I don't think, but still pretty painful for something which is supposedly well diversified.
That's in nominal terms, yeah?
Yeah, that is nominal terms, yeah.
But it was, and I guess still is, the worst bond crash in history, right?
Oh yeah, it was atrocious. And for people who had a lot of duration risk going into it, it was even more painful. And I think a lot of people didn't know about duration risk until this happened. Well, those people certainly know about duration risk now. And I think that might have made them more wary going into this sell-off. So maybe that's a good thing. But I think it's worth drilling into exactly what's going on when bonds and stocks fall together. Now, obviously, they're driven by different things usually. Equity usually feeds off economic growth. So good economic conditions, good for equity, good for earnings growth. That's bad for bonds because higher interest rates at the long end of the curve usually go hand in hand with higher GDP growth. Higher yields mean lower prices. So they feed from different things. They're driven by different things. However, one thing which is toxic to both of them is inflation, because inflation eats away at your coupon, your principal over time, and bonds provide no protection from that, at least conventional bonds. And at the same time, for equity, if you've got higher input costs for companies, usually that results in lower margins. Inflation does have to be above a certain amount in order for that to happen. It has to be, 4, 5% in order to really eat away at margins. A bit of inflation doesn't hurt equity, and it's very good inflation hedge over the long term. But during these inflation spikes, you get big sell-offs. Plus, usually the central bank raises interest rates to fight inflation if we get an inflation spike. And again, that's usually seen as bad for equity because you're discounting future cash flows more heavily. So all of that suggests that an inflation spike is one in which equities and bonds fall together. And then you have to turn to other hedges or maybe go for the shorter end of the curve like I did, which isn't as negatively impacted.
And it's not even inflation itself that's bad, is it? It's the expectation that inflation is going to pick up, which is what we've got right now. Like on paper, inflation is 3%, but people expect it to go to 5 or 6% potentially over the course of this year as the oil shock and the gas shock feeds through into the economy.
Yeah, it's a bit like playing poo sticks. You throw the sticks down under the bridge on one side, and then you rush excitedly over to the other side of the bridge, and you see the sticks hopefully arrive on the other side. Unfortunately, in this case, not quite so exciting, because what comes out is an inflation shock later on down the road.
A rare strait where things are flowing through at the moment.
Oh, very, very good. But that lag can be quite long. So here we're talking about sometimes even 6 months or even more for the inflation shock to feed through. And then, of course, you get the secondary effects, which can also be very damaging. People can anchor on higher inflation because one of the really salient things that people notice is how much they're paying for petrol or gasoline, because that's something which is very visible. The rest of the inflation basket may not be as keenly felt by people. And if you're paying more for petrol, you'll be thinking, well, I should earn more in order to counteract that. And many businesses will see it as an input cost, and they'll put up their prices. So it is anchoring and second round effects, which can be really damaging.
I suppose one thing we have going in our favour slightly now that we didn't have in 2022 is that rates coming into this were not on the floor. Like they were basically zero going into 2022. And so there was no income cushion, if you like, for that bond sleeve. Whereas at least now, bank rate is 3.75 coming into this.
Yeah, I've just been spending a lot of quality time with Claude, rewriting all of our trackers, and particularly the one which shows you the yield curve. So now we've got this slider, so you can actually go back in time and look at the yield curve at another point. And if you look back at 2022, it's almost laughable, because the yield curve is essentially zero. I mean, across the entire term structure. So clearly that was very unusual, very weird. And it was weird for a long time. So people got used to it. And that, I think, made them almost blasé about the possibility that it would go back to normal. People just assumed that would persist forever. So you're right. I think now we've got a lot more income built into the yield curve. And also there's another way of looking at this, which is I mentioned that the longer end of the curve was driven by inflation expectations and growth expectations. You can actually run it the other way around and do a regression analysis to work out what level of GDP and inflation does this yield curve suggest. And then now I'd say it's pretty much in line.
I suppose we can't talk about an energy shock without referencing the 1970s, which is the most notorious episode from history where oil prices really spiked to extreme levels. Again, a lot of that was to do with the Middle East. And in fact, the International Energy Agency says that the current crisis we're going through could actually be worse than the two 1970s episodes combined. Did you see that quote, that worrying quote, Romin?
Yeah, I mean, a shutting of the Strait of Hormuz, that's never happened before. And obviously in the 1970s, we had an oil embargo. And America at the time was heavily dependent on those oil imports. Strategically, they've done something smart, which is to produce more oil domestically, so they're less dependent on energy. But talk to any energy analyst, and this is the worst of worst case scenarios that they've ever imagined. In fact, some of them are saying that this is possibly the worst possible outcome.
Yeah, that always seems like tempting fate to me. Like, at the moment, at least, if we reopened the strait, we'd have lost, a month or so of output, and there'll be some impact on output going forward because you can't just flick a switch and turn everything back on. But at least, the oil fields are there Not many of them have been burned. The worst case scenario is the Middle East is impaired for years and years because Saudi Arabia and Qatar and Iran all lob missiles at each other's oil wells and infrastructure. We haven't had that quite happen yet, though it's been threatened.
Well, we've already had some damage at some of those production facilities. It wasn't a full-out conflagration, at least not yet. But if this war does widen, then I think all of these are possibilities, which are really quite worrying, because we're just not geared up for a world in which we don't have imports of energy from the Middle East.
It's incredibly important still. Sounds trite to say it, but it really is.
And the weird point, which seems to have slipped past Trump, is that the price of oil is global. So even if it's not the case that the US imports oil from the Strait of Hormuz, its price that it pays for oil is also going to be affected by that bottleneck. So that's still a drag on the US economy.
Trump seems to be of the mind that he can manipulate the market somewhat with what he says. So it was no shock that just before markets opened on Monday, he came out and said, yeah, we're in really productive talks with Iran about ending this conflict. Who in Iran? Can't say. What are the concessions? Can't say. Like, no one really knows what's going on. So that's what he says. But then look at what he does. And there's a lot of US troops on their way to the Middle East right now.
Yeah, lots of Marines. And this is precisely the kind of war that US citizens don't want, which is boots on the ground in a country in the Middle East where they don't really feel that America should be. Certainly given their experience of wars in the past, in Iraq, Afghanistan, did those make a material difference to the outcome of the Middle East? And was that outcome positive? I think that's a pretty difficult case to make.
Did you see that article in the FT this week by Alex Barker called Trump's Iran Playbook was written in the 1980s? Because I didn't realize some of this stuff, where Trump actually flirted with running for office, running for president in the late 80s. And there was an ongoing Gulf crisis around the Iran-Iraq war. And in 1987, Trump actually said that the Iranian Navy, is a joke. Little runabouts with machine guns, he said, and they're holding America to ransom. Why couldn't we go in there and take some of the oil fields near their coast, he said. And then I'll quote this bit from a 1988 interview with The Guardian, where he said, if one bullet is shot at our men or our ships, I'd do a number on Karg Island. I'd go in and take it. Now, he's sending right now a lot of amphibious landing vehicles and Marines to the coast of Iran. And there are noises coming out about the US trying to sort of blockade Karg Island or hold it, which, remember, is the oil terminal where something like 90% of Iran's oil flows go through. It does seem ominous. I mean, maybe he's doing both things at the same time. He's trying to negotiate with a gun on the table.
Yeah, I think that's the policy. But will this work in terms of regime change? Certainly so far it hasn't. And that's been pretty surprising because I don't think the regime's got a lot of support internally. So it is surprising that it has been so resilient. So the really awful outcome, I think, would be for Trump to declare victory, pull out, and then we've got an emboldened Iran, which essentially now controls the Strait of Hormuz and can hold the world to ransom.
And is charging toll fees effectively on the small number of boats that are running through the strait to deliver oil to China and other places in Asia.
So I think the ability to pull out of this war, starting the war was a choice, but ending it isn't a choice, certainly for Trump.
Did you see that an interviewer asked Trump, well, what's going to happen with the strait? And he said, well, maybe I'll control it alongside the Ayatollah. Did you see that? Form some sort of JV, joint venture with the Ayatollah. I mean, that's the way out of it, isn't it? It's just share those toll fees with Trump. That'll get the deal done.
Oh, that is funny. But yeah, I don't think that's going to happen.
I mean, that's all the craziness that seems to be happening right now. But let's wind the clock back, like we said, to the 1970s. Because in that era, there was stagflation caused by these various energy crises. So from roughly 1973 to 1982 in the US, real 60-40 returns were negative on average. The S&P 500 delivered around minus 2% per year in real terms over the decade, which cost investors something like 20% of their purchasing power in the US. Bonds did deliver a small positive return, but nothing like in the decades to come after that. And in fact, as we've discussed before on an episode, Romin, investors' love of the 60-40 portfolio and their trust in it really comes from that 40-year period of disinflation we've had since the early 80s. But some people are saying, well, that regime ended in 2022, and this current crisis is just reinforcing that shift.
In fact, you could argue that that 30-year bull market for bonds came after that huge spike in inflation, which we got as a result of that 1970s crisis period. So the 73 Yom Kippur War, the Iran Revolution in 79, both of those caused that mega spike in inflation, followed by a mega spike in the policy rate from the Federal Reserve. And the next 30 years was simply the market healing, the bond market.
It was long-term mean reversion, and it kind of overcorrected in the period since the financial crisis, right? It's like a really long form of what we see in the day-to-day of markets.
Hopefully things happen more quickly this time. So if there are shocks, it's going to be shorter lived. But that was a mega spike. I think it's difficult to even imagine that kind of inflation nowadays and the duration of the inflation spike, but also the magnitude of the oil price increase. So we're talking about a quadrupling. So for the Yom Kippur War, we went from $2.70 a barrel to something like $13 a barrel. During the Iran Revolution, from $13 to $40.
It sounds like lovely prices until you remember to inflation adjust them.
That's right. So, these shocks, the shock that we've seen so far at least, compared with those shocks, is pretty subdued.
From a portfolio point of view, a lot of it comes down to correlation, doesn't it? So I can see that between the year 2000 and 2020, for that 20-year period, the correlation between stocks and bonds was negative. They hedged each other, and the correlation was around minus 0.42. But since COVID, that correlation has flipped positive. It's been volatile back and forth, but generally more positive than negative. And there has been some research I've seen which says that if the stock-bond correlation rises, so it goes from minus 0.5 to plus 0.5, you can expect the volatility of a 60-40 portfolio to increase too, obviously, and it increases by around 20%, and drawdowns increase by around 30%.
Again, I think it's important to remember duration here. So if you look at the duration of cash or money market funds with equity, it's almost always zero by definition. If the volatility is close to zero, so will the correlation be. So what we're talking about here is longer duration government bonds. And there, the relationship, the negative correlation relationship, depends completely on what's going on with inflation. If inflation rises above a certain amount, the correlation flips positive. And that's happened so many times in the past because of this toxic combination for equity and bonds. So if we are entering a new regime when inflation is suddenly going to be affected by lots of the supply shocks, not just for oil, but for other commodities, which maybe feed off the same choke point. So that could be things like ammonia, helium we talked about previously, or it could be things like rare earth metals, even more esoteric commodities, which people have effectively forgotten about. Mines which produce them have been underfunded for a long period of time because people were all talking about sexy things like AI, tech, the Mag 7. Who wants to invest in a mine when you can invest in Apple? But that means that the supply shocks, if anything, are going to come more regularly. And that in turn suggests that you may want to hedge slightly differently.
But most ordinary investors are not hedged in that way. The 60-40 portfolio has obviously had increasing critics in recent years, but it's still probably the most popular style of portfolio. And a lot of people are in it by default, aren't they? If you're in a target date retirement fund, the mix between stocks and bonds might be changing over time, but it's still that same philosophy of relying on the two to dampen volatility.
Yeah, the only exception I'd say is that if you look at something like Vanguard's target retirement funds, they start to mix in more inflation-linked bonds as you age. Now, those do provide you a hedge. It's not what many people expect, but they do provide an inflation hedge.
They don't provide a hedge necessarily against a rise in yields across the curve and a pickup in real interest rates.
That's right. And many people asked me after we had the big sell-off in gilts in 22-23, look, I had inflation-linked gilts and inflation spiked. Why didn't my bond go up? Well, in fact, it did. But the inflation effect was more than counteracted by the increase in real yield. And this time around, we're not going to get that. So I doubt we're going to get real yields going from where they are today to 4 percentage points higher than they are today. That's very unlikely. Whereas I think inflation may well surprise on the upside compared to what's priced into the curve already. Now, you can't see me because this is a podcast, but I do look quite haggard because I've been up at night and early in the morning trying to get this linker code working. And I'm very confident now that I know what the break-evens are. So I'm looking at the UK yield curve right now, and I've got linkers on it. I've got nominal government bonds, the regular ones, and the gap between the two, between the real yield of the linkers and the yield to maturity of the normal government bonds, is what's called break-even inflation. Now that tells you what's priced into the curve. What rate of inflation are markets expecting in order to make the two roughly equal? And at the moment, it's pretty much equal across the whole yield curve, a bit more at the short end than the long end, but about 3 percentage points.
And that's RPI inflation, remember. Index-linked gilts have always been tracking RPI. It's scheduled to change at some point to CPI, or CPIH, in fact.
Yeah, that's right. And it's going to be a fairly clunky shift.
I guess if you were worried that duration risk would overwhelm the interest rate linkage and that protection, you could go for short-dated inflation-linked gilts.
Yeah, the difficulty always is there's less of them. It's not even as liquid as a UK regular gilt curve. But yeah, they do exist. You do get shorter dated inflation-linked bonds, T27, T28, T30I.
Well, there's always a pipeline, right? The ones that were long-dated are coming closer to maturity all the time.
Yeah, that's right. I'm not sure that the government's going to have such appetite for issuing this stuff because the structural buyers of it, which is largely insurance companies, pension funds, their appetite for it seems to have subsided somewhat. Plus, given all these inflation spikes, it's making it really expensive to service that debt.
I guess as gilt yields have jumped in the last week or so, and by an incredible amount at the short end of the curve, we should just be grateful for Liz Truss and the fact that she flushed out the LDI problem from the system before wartime. Imagine if that was going on right now as well and there was a doom loop in the gilt market.
Yeah, I never thought I'd be thanking Liz Truss for that. But there we are. I think you're right. I think that problem is much less of a problem than it was. Today's episode is sponsored by Lightyear, the investment app I open my 2025-26 stocks and shares ISA with. So why Lightyear? Honestly, it fits the way I invest. The app is clean and straightforward to use, and their stocks and shares ISA has no trading fees. They've also just removed the trading fees from their general investment account and significantly reduced their FX fee from 0.35% down to 0.1%, making Lightyear amongst the lowest cost brokers in the UK. Fund manager fees still apply, but you can now trade thousands of stocks and ETFs at a lower overall cost than before. If you'd like to give Lightyear a try, use the code PensionCraft or follow the link in the show notes and you could get between £10 and £100 in your general investment account. Terms and conditions apply, details are in the show notes. And as always, investing involves risk, and the value of your investments can go down as well as up.
So we've talked about how higher inflation is bad for stocks and bad for bonds generally, but that's not true of all stocks. In an energy crisis, where the price of oil and gas rises sharply, clearly energy companies tend to benefit, and that can offset some of the losses from the rest of the equity index. However, if we look at equity indices around the world, the energy sector actually is making up an incredibly small part of the index now. It's been compressed from around 25% of the S&P at the start of the 70s during that massive energy crisis to around 3.5% now. So maybe that internal natural hedge that a passive stock fund would give you is just not there anymore.
Yeah, certainly if you look at a particular sector of the US market, which is energy, and there's an ETF called XLE, which is a SPDR fund, is a SPDR Energy Select Sector Fund. That's up over 30% year to date. But it's such a small proportion of the overall index, as you said, that that's going to provide cold comfort for a broad index investor.
Yeah, it's up massively year to date, but it's only 3.5% of the index. So it's only contributing something like 1.2 percentage points to the index return. It's not going to offset massive losses in the rest of it, whereas it would have had a meaningful contribution if it was still 25% of the index as it was in the 70s. And in fact, 35% of the index at its peak in the early 80s.
So that's a story for the US. For the UK, I'd say it's quite disappointing because we were actually outperforming the US quite handsomely until this really kicked off. And since then, we've seen the US outperform the UK. So the UK's fallen more if you look at something like the FTSE 100. And that's despite the fact it's got a lot of energy inside the index.
It's weird, isn't it? The FTSE 100 has a much bigger energy sector than the S&P 500. I think around 2.5 times the size in terms of weighting. Yet the FTSE 100 index fell into a correction. It was down more than 10%, whereas the S&P 500 hadn't fallen that far.
I wouldn't overestimate how much energy it's got in it. So, for example, it's got BP and Shell. Those are the two big components. And those are up about 16, 13% over the last month. But I think the problem is there's just not enough oil in the overall index to save it.
I guess the spike in UK yields has been worse than the US as well, which weighs on the index. Now, I know the FTSE 100 is not a UK-focused index. Something like 75% of its revenues come from overseas, but it's still exposed to the UK somewhat.
Yeah, a lot of its components have been hammered over the last month. There are things like any kind of house builder like Barratt, that's down almost 30% over a month. Persimmon too. And then, of course, all the miners like Antofagasta, Fresnillo, Anglo-American, those have been negatively impacted. So overall, just a toxic combination of sectors when it comes to this kind of crisis, unfortunately.
I think at a macro level, looking at the global stock market, if we have a crisis like this, an energy crisis which persists, obviously it would have been nice to have more energy stocks in the indices. But also the things that do dominate the index, tech companies basically, they tend to be massive consumers of energy, particularly now where it's all around building out AI data centers. Is that the other end of the vulnerability?
I think it is. And I think that concentration is really going to hurt now, particularly of things like helium exports, which are used in chip manufacturing. Those have also been negatively impacted by this supply shock because a lot of those are produced in the Gulf and shipped via this Strait of Hormuz. If those chips massively increase in price, then it's going to cost a lot more to run these data centers.
Plus just powering the inference, right?
Especially in the US, where they've made this choice to pivot away from renewables and into things like fossil fuels.
But having said all of that, the S&P 500 is down just 4% year to date as we record this. We're talking like this is a massive shock. The IEA is saying, guys, this is the biggest energy shock we've ever seen. And at least the stock market is kind of shrugging and saying, all be all right. Maybe it will.
I think to some extent, markets are still pricing in a short, sharp shock and that they expect that energy prices will fall fairly soon after this ends. I think that's a little bit optimistic. I think it's actually looking like it's going to be much more protracted than people expect.
I think that too. But then I wonder if that reflects our natural biases as people. We're obsessed by the news. We watch markets every day. We're probably both quite cautious and skeptical people. Whereas the optimists are usually right in markets.
Yeah, I mean, I'm an optimist when it comes to the portfolio, the core portfolio, where I haven't changed anything. With my fund portfolio, slightly different, but there I've always been cautious. But am I really piling into risk right now? No. Maybe I should have done. Maybe this was an opportunity which I've missed.
I don't know. There's not been a massive crash or anything. As opportunities go, you might get a better entry point.
Yeah, and that's why I'm keeping my dry powder. I think there could be better opportunities down the road. And if this does kick off, if it does actually get worse or expand in terms of the crisis, the war, then I think there could be some really quite attractive buying opportunities in the equity market.
So we've talked about stocks, we've talked about bonds. There are good reasons to be nervous about both of those things right now. But even if you were one of those investors who had a broader portfolio and had mixed in that safe haven asset we all love, gold, you wouldn't be any happier right now. In fact, you might be less happy because gold is something like 20% off its all-time high and has fallen throughout this crisis.
I'm just looking at prices changing over the last month, and I see gold down 16%. In fact, it's the biggest red bar on my cross-asset indices bar plot. So that's pretty shocking for people who think of it as a safe haven, an inflation hedge. Well, it didn't turn out to be those things in this crisis so far. I think dollar strength, increasing interest rate expectations, both of those are toxic for gold. Plus, it was so expensive going into the crisis. I think that certainly weakened its role as a hedge.
Yeah, I agree with all of those reasons. But there's one other element here, which is a structural thing around gold, which some people have pointed to, which is that part of the reason it's had this massive bull run over the last couple of years is because central banks and institutions around the world decided to diversify a bit away from the dollar and have turned to gold for that purpose. So a lot of central banks and governments in Asia have done that and in the Middle East. And now those economies are less able to buy gold, partly because they've got to buy a lot of oil and energy right now at higher prices as currencies are weakening, and partly because the money is just dried up for Middle Eastern economies, right? They're not able to sell as much oil as they were before, nowhere near. And so the bid for gold has been weakened by that.
Yeah, there's never much transparency around what central banks are doing. They don't report everything. But one of the arguments I've heard is that they're having to protect their currencies. And one way to do that is to sell their gold in order to protect their currency. So, maybe that's one of the reasons as some of these gold purchases go into reverse.
If you look back through history at various big crises, it's not actually unusual for gold to suffer in the early stages and then rally as the crisis drags on. So gold did fall very early on during the COVID crash, as did pretty much every other asset, and then had a massive rally coming out of it. Gold fell during the early stages of the 2008 crisis before resuming its safe haven role. So perhaps we'll go back to a gold rally pretty shortly. That's certainly what investment banks are expecting. They've still got much higher price targets for gold than where it is now.
Yeah, one of my little experiments for my core replacement is this global efficient core portfolio, which is levered 60-40, commodities and gold. Now, the commodities have really rallied because there's a lot of energy exposure there. But the gold bit, obviously, quite disappointing. But the whole thing's only down about 4% from its peak. So I'm quite happy with that so far. It's good for this crisis, at least. You never know whether it'll be good for future crises.
I mean, certainly during an energy crisis and a supply side crisis, you'd think commodities broadly are going to rally, right? It's kind of by definition, that's what's causing the crisis. We go back to that stagflationary period in the 70s and early 80s. The broad commodities index delivered something like 15% returns annualized. Gold was around 9% real returns. Cash roughly matched inflation across the period. And other real assets did quite well. Farmland, even REITs did okay. But as we said earlier, equities and bonds did not do well. An interesting thing that sometimes does do really well during these kind of regime changey shifts are trend funds. Now, I know, Robin, we have different opinions on this. As I messaged you last week saying, I'm looking at these managed future trend funds where they seem to have uncorrelated returns to both stocks and bonds, yet higher returns than cash over the long term, like the dream combination. And you said, Michael, I've got a bridge to sell you. What's going on here? What are these things?
So the idea here is that there's either an algorithm or a human which decides which way to go in the futures market. So they can go long or short, and they can switch between the two very quickly and cheaply. And they can do that in almost anything where there's a futures market. So it could be commodities, FX, equity, bonds, anything you like. And they can ride the trend up or down and make money from it if they predict which way it's going to go. And I think that's the difficulty. Are they going to be able to predict which way markets go? And based on information from other markets, the evidence would suggest that it's unlikely.
But momentum is a genuine signal and a powerful signal in markets. You're just concerned whether you can get on the bandwagon and crucially get off the bandwagon at the right time.
Yeah, I mean, I don't think this is an infinite money glitch. If it was, I'd just buy it levered, right? I just buy it all day, but I'm not going to do that because I just don't have that much faith in it. I'd much prefer something like cash, which always provides the hedge. And what's interesting is that in real terms, it's also beaten inflation, not by much, but by a bit.
But you know what beat inflation by a lot in the 2022 sort of mini stagflation episode was these trend funds. But that was, I guess, the perfect environment because the trend persisted for a long enough period. It was like almost a year in duration. Maybe the concern now is with the volatility of what Trump's saying and the volatility of markets up day to day, maybe there isn't a trend to follow.
I think that's the difficulty. And I think also the difficulty is that you're paying a large fee for those, and that may eat away any extra performance. But look, you combine leverage and the ability to go long and short, and yeah, you're going to perform well in some regimes, sometimes spectacularly so.
But I only want it to perform really well in these regimes that we had in 2022 and that we might have now, because you're buying it as a diversifier, right? As long as it does the job in that situation and doesn't lose you a load of money the rest of the time, jobs are good, aren't they?
Yeah. I mean, if we do get a crisis which is prolonged and goes in one way, yeah, maybe this would work. But I don't think I'll be buying them. But let's see what your experience is. I think it's great that you're trying this out.
I guess the trouble with everything you buy as a hedge is that it might cost you long term. Certainly if you're buying a commodities index as a hedge, the carry cost there is typically negative. There's roll costs going on as the fund manager keeps having to buy new futures, usually at a higher cost than the ones that are expiring. And commodities have underperformed cash over the long term, albeit with these periods where you get a massive spike and they diversify your portfolio. So you could definitely say there's a case for holding them as part of the portfolio mix, as a small component where they might improve risk-adjusted return at the cost of lower overall total return.
Yeah, and I think it's the forgotten part of your portfolio. It's the stuff. That's why I loved Ed Conway's book about the material world, because it's the things we don't usually think about. Things like glass and the quartz that goes into it. Things like iron, which just aren't very sexy, but which are really important.
Things like rubber, which aren't very sexy. Oh no, it is quite sexy.
And I love this quote from Zoltan Pojar, who said, "You can print money, but not oil to heat or wheat to eat." I've heard another way of describing it is that you can't print atoms. So the point here is that central banks can't bail you out in these stagflationary shocks. But these kind of commodity hedges do protect you.
But it's going to be volatile if you're just looking at the commodity fund.
Oh yeah, you'd never have pure exposure. It would be part of the overall portfolio mix.
Because maybe we focus too much on the fact that they spike in these crises. But we should also say that they crash extremely quickly when the crisis is resolved.
So, you could be lucky with a rebalancing, but the overall portfolio volatility as a result of this behavior, if it is one of these commodity supply shocks, then it is lower than it would be without it.
Have you considered moving your core portfolio to have more broad asset exposure and not just be composed of stocks and bonds, albeit short duration bonds at the moment?
Yeah, I mean, that's why I have this levered 60-40 experiment, just to see if I do mix in some commodities, some gold and some broad commodities, whether it's going to improve the risk-adjusted returns. And certainly so far, it's looking pretty promising because it hasn't had much of a drag during the rallies because effectively I've got a 60-40 portfolio. And then I just layer the returns of commodities on top of that. But look, there's going to be some crisis at some point where this thing's really going to come unstuck. I'm just worried that I'll pile into it before that happens. So maybe I'm just too cautious. But I'm quite wary of these newfangled things.
And everything comes at the cost of simplicity, right? If you're saying, okay, now I'm going to mix 5 assets. I'm going to have global stocks. I'm going to have global bonds, some long-term, some index-linked, some short-term bonds, some cash, some commodities, some gold. Okay, you've got the ingredients, but what's the recipe?
Yeah, for me, it was based on backtest. So this was, 66% levered 1.5 times. So that's going to make up my 100. So that was an easy choice. And then equally split between gold and broad commodities for the remaining third. So 3 funds for me is what gives me that exposure. But you're right, it is more complex. And I think the other thing which people forget is the benefit of shorter duration bond exposure. People assume that all bonds are the same, but that's completely not true.
I suppose the thing I worry about doing a podcast like this is that people take away the wrong message and start trying to time things with their core. They get panicked about what's going on literally right now and think, okay, I should have always had commodities in there, a small 5% allocation to commodities. Now's the time to put it in. I probably should have had gold too, and they put a bit of that in. And they just start accumulating these assets and going away from their long-term allocation. And inevitably, they're adding assets when they're doing well, when they're in the press, when we're talking about them. And if you're looking at gold, for instance, if you were just adding it now, you'd have missed out on that huge rally we've had over the last couple of years. I'm not saying it's necessarily the top in gold, but it could be. The point of the core is it's meant to be the same for a very long period of time and only change when your circumstances or beliefs change.
Yeah, I think that's really important. And look, I don't fiddle with mine very often at all, if at all. I did switch to 60-40 recently, but that was for personal reasons, circumstances changing. Kind of glad I did in retrospect, and the timing was quite fortuitous. But look, am I going to massively change my core on a regular basis? No. And it's a really conscious decision to do that because, like you say, we're bombarded by news flow. We have to be, given our jobs. So it's really tempting to get buffeted by that information and change your core, when really you should just stick with it. Now, I mentioned the tracker I've been very busily writing recently. You can access that as part of our membership and watch the yield curve unfold before your eyes. To learn more about that, just go to PensionCraft.com/membership to learn more.
Okay, today's dumb question of the week. What is the Bloomberg Aggregate Bond Index? Now, we talked a lot about the idea of a 60-40 portfolio, but the question is, what's in the 60, what's in the 40? For a lot of people, what goes into the 40 might be something like the Bloomberg Aggregate Bond Index. But what is it?
Now, it comes in two flavors. It used to be called the Lehman Ag, after the investment bank, which no longer exists. Now it's the Bloomberg US Aggregate Bond Index. That's what we call the Ag. And it's a huge benchmark for US fixed income. Now, it's not just government bonds. It's got US investment grade bonds in it. But think of it like the S&P 500, but for US bonds. It's also got a big slug of mortgage-backed securities, which is one of the biggest bond markets in the world, which are US mortgages packaged up into bond form. But to be included in that, a bond's got to be investment grade rated, so BBB minus or higher.
So there's no junk bonds in here?
No junk bonds, has to be dollar denominated, and it has to have at least 1 year to maturity. So that's the Ag, it's a US index. If you're in the UK, well, probably you're going to buy something called the Bloomberg Global Aggregate Bond Index, or the Global Ag. Well, you'll buy a fund that tracks it. Now here it's much more broad, so it buys investment grade bonds from around 30 countries, and that's in over 20 currencies. Usually you buy it sterling hedged because you don't want the currency volatility.
So it sounds like what these bond indices are trying to do is something like what the stock indices are trying to do, at least the passive ones, where they look at everything that's out there, they put some kind of quality filter on it. So in the case of this, it must be investment grade. And then they buy everything, proportional to market cap?
Yeah, so it's the amount of debt outstanding in that market. Now, for equity, it makes absolute sense because if it's a large company, it's probably quite successful, it's very liquid, the bid-offer spread's tiny. For bonds, you might scratch your head and think, wait a minute, that is a problem. Because countries like Italy, which have issued a lot of sovereign debt, will have a higher weighting than countries which have issued less debt. So you might be thinking, well, I'm not sure that's a good thing. I think the liquidity argument still applies. A larger, deeper market is going to have smaller bid-offer spreads. But do you really want the most indebted countries having a larger representation in the index? And I think that's questionable, but that's the way it's done.
I think it's interesting that when you look at the S&P index versus active report, where it basically says how many fund managers can outperform their benchmark. And we know the vast majority of active equity funds underperform their benchmark. Something like 90% if you go back 10 years. The passive bond indices does still beat most active managers, but more active managers beat the bond index, don't they?
Yeah, I think it depends on the type of fund. Because to beat a corporate bond index, effectively you're doing the same thing as an equity analyst. You're trying to find which companies have the best fundamentals, and those presumably will outperform. And there, I think they're less likely to have an edge. Whereas if you've got an active gilt fund, you're making calls about duration. There's no issuer difference. It's always the UK government. It's a question of whether you can predict whether rates are going to rise or fall. And maybe people have a better stab at that than they do at name selection.
Certainly your mini bond fund, your 40%, it looks like you made the right call so far.
Yeah, the duration call. Yeah, like all of my investment decisions that worked, it was purely by accident.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.